Dear students, a very warm welcome to the world of macroeconomics. A 30-period concentrated effort is needed to cover this vast unit of economics. But before the factual details of this particular chapter, let us pre-consider ourselves with few questions and some known answers. What is economics? How we can define it? Economics is the study of how people choose to use resources. Now again a revision. What are resources? Resources are the sources which are basic inputs of our required results. They may include time, talent, whatever the people have, the land, the buildings, the equipment, and other tools on hand, and the knowledge of how to combine them to create useful products and services. A simple definition by Alfred Marshall explains a lot about economics. Economics is the study of people in the ordinary business of life. Before taking on the details, we must understand the sub-themes of this chapter. Macroeconomics, consumption of goods, capital goods, final goods, intermediate goods, stocks and flows, gross investment and depreciation, circular flow of income, methods of calculating national income by value added or product method or expenditure method, and even from income method. Then concepts and aggregates related to national income, the gross national product, net national product, gross and net domestic products, national disposable income, gross and net, private income, personal disposable income, real and nominal GDP, GDP and welfare. Now, the very first topic is what is macroeconomics? The Greek prefix macro means large and is a branch of economics dealing with the performance structure, behavior, and decision making of the entire economy. By the entire economy, let you include national, regional, or global economy. Now, when it is macroeconomics, it has to be vast and detailed. History proves that the three types of flows, that is, the capital, labor, and technology, earlier were a dominating factor of the colonial rule. But nowadays, it gives proper share in the national income and economy as a whole. Now, what is the scope of economics? Now, to study the scope of economics, we need to differentiate it with microeconomics. Now, in microeconomics, when the base is production, the production will be coming from production, output in individual industries and business. How much steel? How many offices? How many cars? Whereas in macroeconomics, the production will be national production output, total industrial output, gross domestic product, growth of output. If the base is prices, then in microeconomics it is price of individual goods and services, price of medical care, price of gasoline, food prices, apartments. But on the macroeconomic side, if the aggregate price level is there, it will be consumer prices, producer prices, rate of inflation. Now, under the banner of income in microeconomics, distribution of income and wealth, wages in the auto industry, minimum wages, executive salaries, and poverty. Whereas in macroeconomics, national income, total wages and salaries, total corporate profits, employment by individual business and industries, jobs in steel industry, number of employees in a firm, number of accountants. Whereas in macroeconomics, employment and unemployment in the economy, total number of jobs, unemployment. Such vast is the scope of macroeconomics. When you differentiate it from microeconomics, the things come on to very clear that macroeconomics is a whole new economy of a country. Again, the macroeconomic concepts, they are from regional to global level, since the picture also shows you the same. The blue indexes is the regional. where even if we touch a minimum of it, but we need to touch the regional for the concepts of macroeconomics. And then going higher and higher, the bar goes higher and higher and reaches up to the global level. Such vast is the concepts of macroeconomics. Now, the next is circular flow of income. What is circular flow of income? To understand it, what is circular? The thing which goes on and comes back again. It becomes a circular. What is flow? Which goes on easily and which comes on easily. Now, what is income? Obviously, income is the goods and services, consumer expenditure, the wages, the rent, the dividends, and all these are called the factors of production. The households and the firms and the households. In this simplified image, the relationship between the decision makers in the circular flow model is shown. Larger arrows show primary factors, while the red smaller arrows show subsequent or secondary factors. After the diagrammatic presentation of the circular flow of income, let us study a bit of a detail for it. In economics, the terms circular flow of income or circular flow refers to a simple economic model which describes the reciprocal circulation of income between producers and consumers. In the circular flow model, the interdependent entities of producer and consumer are referred to as firms and households, as you saw in the picture, respectively, and provide each other with factors in order to facilitate the flow of income. Firms provide consumers with goods and services in exchange for consumer expenditure and factors of production. From households, more complete and realistic circular flow models are more complex. They would exemplary include the roles of government and financial markets along with imports and exports. Now, there are some assumptions in the circular flow of income. The basic circular flow of income model consists of 7 assumptions. Number 1, the economy consists of 2 sectors. First is households and the second is firms, and you can even have the vice versa. The first can be firms and the second can be households. Households spend all their income Y on goods and services or consumption. There is no saving, that is S. All output O produced by firms is purchased by households through their expenditure. There is no financial sector. There is no government sector. There is no overseas sector. It is a closed economy with no exports or imports. Now, the 5-sector model of the leakages and injections. Now, all leakages and injections in 5-sector model. The leakages are savings, taxes, imports, whereas the injections are investment, government spending, and exports. In terms of 5-sector circular flow of income model, the state of equilibrium occurs when the total leakages are equal to the total injections that occur in the economy. I once again repeat, in terms of 5-sector circular flow of income model, the state of equilibrium occurs when the total leakages are equal to the total injections that occur in the country. This can be shown as savings added by tax added by import equals to investment added by government spending plus exports, or S plus T plus M equals to I plus G plus X. Now, the other sub-theme of macroeconomics is consumption goods. Consumption is a common concept in economics and gives rise to derived concepts such as consumer debt. Generally, consumption is defined in part by opposition to production. But the precise definition can vary because different schools of economists define production quite differently. Likewise, consumption can be measured by a variety of different metrics, such as energy in energy economics. The total consumer spending in an economy is generally calculated using the consumption function, a metric devised by Keynes, which simply expresses consumption as a function of the aggregated disposable income. This metric essentially defines consumption as the part of disposable income that does not go into saving. But disposable income in turn can be defined in a number of ways. For example, to include borrowed funds or expenditures from savings.